Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. U.S. equity markets are in the green after Trump announced a tariff exemption on select electronics. Today's rally emphasizes the fickleness of Trump's governance style, reflecting the market volatility. By contrast, last week, all U.S. assets were pretty much on sale, which our next guest points out, raising the possibility that foreign investors are retreating on their U.S. capital investments. Our guest says if a trade war morphs into a capital war, then there's more at stake than just tariffs. Joining us now to set you up for the trading week ahead is Fidelity Director of Global Macro, Jurrien Timmer. Jurrien, very grateful for you joining us here today and sort of put some things to rest. But how are you today?
I'm well. It's a beautiful sunny day here in Boston, so and the markets are relatively quiet for a change.
They are. It's a good way to sort of begin. Take us through a little bit of what last week was, in fact, because we've all sort of lived through it many different paces, and many being hurt by tariffs. But we're talking about the investors who are investing in the companies that are dealing with this fallout.
Yeah. So okay, there's a lot to unpack here, but let me just start from the top on slide 1. So as of early last week, S&P had fallen 21.5%. So I'm not quite ready to proclaim that as a bear market because we've had 20% drawdowns that were very quick, that were recovered from relatively quickly as well, like the fall of 2018 comes to mind. And nobody really thinks of those as bear markets. They're kind of like mini bears or bear adjacent markets, as my colleague Denise likes to call it. So I'm not quite ready to throw in the towel, but 21% is a meaningful decline. And it's happening, if we go to slide 2, right as the cyclical bull market, which started in October of 2022, reached the median age of 30 months. So it's a little bit ironic or fitting that this decline is happening right as the bull market sort of reached middle age, if you will. Of course, there have been many cycles that lasted longer and some cycles that lasted shorter. But so it kind of adds to the question mark of, did the cyclical bull market end? And the answer may very well be yes. But I'm waiting to see what kind of recovery or not recovery we get here, and we'll get into that in a moment.
Sure.
But just if we go to slide 3, it's easy to forget how many of these storms we've actually had just in the last 5 years, right? I mean, we had 2022, of course, that was a 28% bear market that really dragged on for a while because of rising rates, and of course we had COVID. 35% in 6 weeks, and then we had 2018, 20% in a matter of a month or two, and even like 2015-16 when the yuan was being devalued, we had about a 16% decline. That one dragged on for a while as well. So we do get these, and the market does always recover, not always quickly, but it does always recover. And so we have to kind of take that into consideration. And at down 20, I mean, we're not down 20 anymore, of course, because the market had a massive rally last week. But, the question is, what do we do? Do we sell strength? Do we buy weakness? Do we just sort of close our eyes and hope that this crazy period in history will pass? But it's interesting, just to put on my technical hat for a moment, if we go to slide 4, we can see that the market did reach legit oversold levels last week. I know that last Monday when we spoke, we were not quite there yet, but of course Monday and Tuesday were big days in the market. So 19% of the stocks in the S&P were at the lows last week were above their 200-day moving average, and only 6% were above their 50-day moving average. And you'll note from the horizontal line in the chart that the market stopped right at the previous high, which is what it did at the previous low, stopping right at the previous high from that, if that makes any sense. And so we've reached, I think, an area where the market has discounted a fair bit of bad news. And of course, there is plenty of bad news to discount. But, that becomes an issue for us asset allocators is like, at what point is enough bad news discounted that even if it's not over, you're at least getting rewarded for taking some risk. And it's interesting on that note, if we go to slide 5, right now, literally as we speak, the market for the second time is retesting. You see that little orange line there. It's I call that the scene of the crime. So that's an old technical analysis thing where if the market breaks down, which it did when it fell below that previous low, it will generally retest that point, and that becomes resistance.
Right.
And if this market is no good, it's not going to go any higher. And if it was just a passing squall and the market's going to continue to recover, it will overtake that level. So 5,500 on the S&P, that's the level to watch. And if it goes higher than that, then maybe we've seen the worst. It's going to go to new highs soon. Maybe we range trade for a while, but it's a line in the sand that us chartists will look at. And I'll give you one more thing before I hand the mic back to you, or two more things. Slide 6 shows, and I remember last week we showed the chart of what happens after a 10% decline, and the answer was who knows, because you can see after 10% decline, half the time the market recovers and the other half it goes down further. So it's of no help. But if we update that chart to show what happens after a 20% decline, it's still true that there's certainly plenty of instances where a 20% drawdown turns into a 50% super bear. But the further down you go, if this makes any sense, the further down you go, the less likelihood you have that it's going to go further, because historically, the odds of, let's say, a 50% decline is only 2%. Right. And the odds of a 20% bear market is 20%, and the odds of a 10% correction is 40%, right? So the further you go, historically, the odds are better that you're seeing the lows. They don't guarantee it by any means, but and this chart kind of shows it, right? It's not always the low. Many times it's not, but you get to the point where at least the market starts to adjust and find some balance and maybe wait for new evidence to come in. And that new evidence in this case would be whether we have a recession or not, to what degree earnings get hit. But so we're at that kind of point where if you did think this was just a passing squall, you've probably seen the worst, and if not, then we've probably seen the worst, at least for a little while. And I'll show you just one more chart on slide 13, and we looked at this I think last week as well, where the yellow band there is obviously the trend line for the S&P, and the market is like a pendulum; it's always swinging above or below. Sometimes it just hangs out at the line, but oftentimes it's just sort of passing through to one extreme or another. And in 2022, you could see, right, we went from well above the trend line to well below. And that doesn't guarantee that the lows are in, but at least you're getting somewhat compensated to take risk. And right now we've done the same thing. So we've gone from above the trend line to below. And again, that doesn't mean the lows are in, but at least I think you're getting somewhat compensated if you're like, okay, I'm underweight equities. I want to buy some. At least you're not buying at the top, right? You're buying at a level where you're getting compensated to take some risk. So I'll stop there.
No, it's amazing, incredible. Let's go to sort of the bond story. There were a couple of auctions that were very closely watched by everyone, but there was this question of deleveraging, this question of unwind and liquidity. It was in the markets, and it was ultimately addressed, wasn't it?
Yes. So slide 8 wins the award of most disturbing chart of the week. So that's the 10-year bond yield in the top, the US dollar index in the bottom. And until a few weeks ago, they would move in tandem, which makes sense because the dollar tends to be the world's funding currency. So at a time of stress, which is when bond yields would normally go down, the dollar would be bid. And of course, that's not what's happening. So last week, basically all U.S. assets were on sale. The only thing that's denominated in dollars that that did well, that had so much winning, as the MAGA folks like to say, was gold.
Right.
And we can talk about gold in a moment. But stocks were on sale, bonds were on sale, the dollar was on sale. Highly, highly unusual. It's the kind of thing you would see in an emerging market where they shoot on their own goal, and it had that feeling to it, and especially the bond market was going through a lot of stress, and it harkens back to, and we don't really know who was selling. We know that the basis trade was being unwound, a highly leveraged trade where hedge funds will buy the cash and short the future, or short the future, or short the cash and buy the future. And most of the time, that's a really good thing because they provide liquidity and orderly markets. But when you have a lot of leverage, and I believe about $1 trillion was tied up in that trade, and it gets unwound, it can get disorderly. And we just have to take a page from the Bank of England back in 2022, when we had the Liz Truss fiasco. The gilt market started to unravel, not because of basis trades, but again, there was an air pocket of liquidity, and the Bank of England had to step in and buy gilts. And it was a temporary program, and they were done with it in a few months, and nobody even barely remembers it. But the U.S. was kind of going through a liquidity air pocket as well, and whether the Chinese were selling or not, very hard to know in real time. Or maybe the Chinese were selling treasuries and buying bunds, and that way they don't have to they can sell the dollar without buying the yuan, right? They sell the dollar to buy the euro. So there's all kinds of things that may or may not have been happening last week. But the bottom line is that rise in yields from 390-ish to 460 in a matter of a few days, really, finally got the attention of the administration, primarily Scott Bessent, who seems to be one of the few adults in the room in Washington these days. And we're happy to have him because he does know what he's doing. But it wasn't the put under the stock market or the dollar or anything else. It is the put was triggered under the bond market, and normally that would be the Fed's role, but in this case it was the Treasury doing it. And so once the 90-day tariffs were walked back, presumably because yields were rising too fast, then that's when we got that huge 10% rally in one day. And then on top of that, we got the news on the semiconductors and iPhones over the weekend, and that's making the market rally some more. But that was really the pivotal moment when the administration said, okay, we can handle a lot of things. We can handle a recession. We can handle a bear market in stocks. Yeah. But yields at 450 we cannot handle.
Right.
And that tells you about as much as you need to know about the state of play these days, when you have a big fiscal cliff, and you have foreign investors owning trillions of it, that you have to thread that needle very carefully. And they're not really threading anything very carefully in Washington these days. They're just breaking things and seeing what happens.
Is there something in what you mentioned there of perhaps foreign investors selling and to exit in bund, or to buy bunds instead, for instance, or even to go to a different currency, perhaps the the euro? Does that speak to the American exceptionalism story? I mean, how much of buying of U.S. assets is to have access to the dollar? I know they go hand in hand, but I guess it sort of brings in the question of growth stocks and what stocks are worth without that element being there.
Yeah, so that is the big existential question. And by the way, credit to David Wolf for coming up for suggesting the idea that because the thinking always was, okay, the Chinese they own like 800 billion of treasuries, and that number's been going down. But if they sell them and they sell the dollar, then they would just buy the yuan, and they don't want a stronger currency. If anything, they want a weaker currency. So they would be shooting themselves in the foot. And so I asked Dave, I said, well, they could be buying gold. He said, yeah, they could, but they could also do a cross currency trade where they sell treasuries and buy JGBs or bunds, and that way they're left sort of neutral on the currency side. And I hadn't thought of that, so that was very clever. But yeah, this is the big question in terms of, are we entering a new structural regime? And so, slide 17 I'm doing a whole deep dive on this, which I ended up with way too much content for this week. So I've deferred that to next week, but I'll have a lot more on this next week. But so we used to have the gold standard. Then we had Bretton Woods, where the dollar was tied to gold and all the other currencies were pegged to the dollar. Then we had sort of the fiat era starting in the early 70s. People call them petrodollars or whatever, but it was the area which we kind of call Bretton Woods Part 2.0, where the US would vendor finance the rest of the world, right? So we would go and buy oil in the Middle East, we buy stuff in China and other places, and those dollars that we send over there, they end up getting recycled back into our markets, into the treasury market, into the FDI, equities, what have you. And if the Trump administration is putting an end to that, which it seems that they're trying to do, where we are no longer vendor financing because we're going to make everything in-house, which I think is highly unrealistic, but that's a different topic perhaps, then the dollar loses its place as the dominant reserve currency. It will always be a reserve currency, of course. We're always going to buy oil. Well, actually, we don't really have to buy oil anymore either. But if you see there, the purple line, that's the share of dollars of world reserve currencies. And we're at 57%.
Going down for a while. Yeah.
Yes, it's been going down for a while. And of course, that makes sense because you don't only have the euro and the yen, but you have the yuan. And so that's part of globalization, is that other countries start to come up. But in this sort of scenario, that line would continue to go down and less gets traded in dollars. And then, if a trade war turns into a capital war, right? Like if China says, okay, you slap us with some tariffs, we're going to slap you with tariffs, and we're also going to stop buying your currency. Then you get into the question of, okay, well, how big are non-US investors? And if we go to slide 18, the answer is they're very big. This is the from the Fed's flow of funds report. So international investors of any kind own about $18 trillion of equities. And in the next slide, they own about 15 trillion of bonds. So that's not just treasuries, that's bonds. And this includes, international pension funds. And it's not just central banks. They wouldn't own equities, presumably anyway. But if the tide is turning in a structural way, it raises all kinds of questions. So I've done a lot of work on the secular trend. And if we go to slide 20, you can see that, we have secular bull markets, we have secular bear markets. The bull markets tend to last about 18 years, and they produce not quite double the average rate of return, but close to it, about 18%. And the norm is about 10, 11%. And then secular bear markets are a little shorter. They're about 14 years on average. And they don't necessarily go down, but if they go up less than trend, and again, trend is 10, 11%. And so the question, of course, is we are now at a point, if we go to slide 21, where, like we know that the cyclical bull market is at middle age. And the secular bull market is also getting on there in terms of its age. We last year we called it the 7 and 7. Maybe it's the 8 and 8, or even the 9 and 9. Who knows? But so as you get longer in the tooth, you start asking questions. Okay, for the secular trend to change, there would have to be some kind of regime shift, right? And then the question is, what are the attributes of the current regime? Obviously, the Mag 7. U.S. mega cap growth stocks, U.S. exceptionalism, those are all attributes, and we don't want to confuse correlation with causation, but I think it's safe to say that when you look at the current valuations and the concentration, that they all go hand in hand. And so, again, maybe it's too early to be contemplating this, but we have to ask the questions that if the administration is really ushering in a new era where it's mercantilism instead of, this benevolent sort of global force that the U.S. has been, really for many, many decades, then we have to ask those questions. And again, next week I'll have a lot more to say on this. But if we go to slide 22 for now, again, you look at those secular bull markets overlaid there in the top panel. And again, we're not quite at the end, but again, the sample size is very small. There's only been 3 of them. So we can't really rely on the average of 18 years. This one could be over now, or it could go for another 10 years. And we don't really have statistically a robust data set to back us up on that. But if you look at the 10-year CAGR, the 10-year rate of change of various important pair trades, right? So US growth to value, large cap to small cap, US versus international, commodities to financial stocks or to financial assets. They have generally all been moving in the same direction, and that's mostly because of the Mag 7. Because if they're on one side, everything else is going to be on the other side. And again, you can kind of see a very long cycle there of about 3 decades. And so this cycle, might be turning right at the time that the secular trend is becoming more mature. And that just leads me to think that if there is a change of the guard, it's going to have massive repercussions for all of us asset allocators. It's going to affect, whether the dollar remains an anchor. I think it will to some degree, but whether, if the Mag 7 are no longer outperforming, then you go to international, you go to value. And also it's an environment where you just get less beta, right? And that's why I titled my report The Alpha and the Beta. And that's an important thing to distinguish because, you are all shepherding assets for your clients. And the last couple of decades have been pretty good, right? I mean, the market has been going up about 14, 15, 16% a year on average in real terms. And when you get that amount of beta, even if you take a misstep on the alpha side, it's not going to break the bank. You might be more easily forgiven for underperforming in a strongly up market. But when that beta starts to shrivel and you go from 15% to 5%, which is not a prediction, but something on that order, the alpha is going to matter a lot more because there's just less beta to go around. And I think that that could be really the main focus for the next 5-10 years if we are truly in a regime change. And who knows, right? All kinds of things can happen. Like I said, Scott Bessent is the adult in the room, and he clearly has the president's ear. And if other things break, who knows? Maybe he will win the day, and people like Navarro and Lutnick end up resigning. Like, who knows, right? And then all of a sudden you have people with fairly high conviction positions that are maybe not always rooted in reality. Let me put this as diplomatically as possible. If those people all of a sudden disappear, you might actually get a much more stable, normal behavior. And all of this was just an academic exercise. So I don't want to overstate the case.
Sure.
Things are very fluid in Washington and people come and go. That's what happened during the first term. And we'll see. But so that's kind of my big picture thinking. But again, more to come at next week's show.
On sort of the secular piece of it. Okay, that'll be fascinating. There's a couple of questions that have fit into that idea of asset allocation. So one question is, was the market selling as a result of institutional consolidation in bonds, in treasuries? Had it leaned too far on some level?
I think the Treasury market hit an air pocket, and I don't get the sense that it was just regular institution selling. Like the news moves too fast for that, right? So I think this was hedge funds in the basis trade, and it was just and you can see, I don't have the charts here, but we get charts from our trading desks that show kind of the depth of the market. And when it starts to move, the liquidity just evaporates. And that happens in equities as well. And it's one of the reasons why you get these outsized moves. And so my sense is that these trades were being unwound. And the same thing, by the way, happened during COVID. Again, the basis trade got unwound. The Fed had to come in and step in. And so my sense is that it was mostly technical, but again, were the Chinese involved? Was the Chinese central bank selling? It's hard to tell, but a lot of the action happened actually during the off hours, which was interesting. So we don't really know. These things usually come to the surface well after the fact, and then it's like, oh yeah, of course,
Got to write
that
the
was the
history
reason.
book.
But for the most part, my understanding is that there's just a massive air pocket in liquidity that's been at least restored. We're back at 440, but we went up like 60, 80 basis points in a matter of days, and that gets the attention, and it got the attention of Besant in Treasury, which is good.
Another question here. Yeah, interesting. So should Canadian equities be correlated to U.S. equities in the current market? Yeah, it's interesting.
Well,
Are they
the
international, I guess, because we're such a close trading partner, but
I mean, the U.S. market is obviously dominated by the Mag 7, right? I mean, they're less dominant today than they were a few weeks ago, but they're still about 28% of the market. And so that has been the story really around the world for the last 10 years. So it's growth to value, it's US to international, but it's, the valuation changes, of course, the US at 22, the rest of the world was at 14 at the peak. But to me, it's has less to do with with how good the rest of the world is. I'm trying to say this in the right way.
I see what you're saying. Yeah.
It has more to do with whether the Mag 7 are rising or falling. And again, that's why I just mentioned the alpha and the beta. So if the Mag 7, and again, this is not a prediction because their earnings continue to be holding in pretty well, and their valuations certainly have come down. They were trading at 40 times earnings, a month ago. They're at 30 times today. So maybe they come back and they make new all-time highs, and we continue on that road. But to me, what happens in the rest of the world, including Canada, relative to the U.S., really just comes down to the Mag 7. There are other elements, of course. Of course, if Germany is doing a fiscal impulse to beef up its defense spending and infrastructure, that obviously is something that's independent of the Mag 7. But if the Mag 7, if that reign ends, then everything else starts to outperform in the alpha sense, not in the beta sense, but in the alpha sense. And that's why my hunch is that if we have a period on our doorstep of rest of the world outperformance, it's not going to be in a sharply rising market the way the last 10 years have been, because if they outperform the Mag 7, that means that money's coming out of the Mag 7. And if money's coming out of the Mag 7 and they're 30% of the market, it's going to be very hard for the market to actually go up or go up a lot. And so I think that's, again, the alpha versus the beta is a very important thing to think about. Also in terms of messaging to all of your clients, right? It's just setting expectations, and I think that's that's something we all need to kind of contemplate here.
Okay, just a 30-second word to earnings. We're in earnings, and we've even seen, it's the estimates and then the forecasting ability and guidance ability. I guess just a quick note, if you could.
Yeah. So slide 14. So, first quarter earnings season, of course, is underway, but that doesn't really tell us anything because it's the first quarter and it's already ended. So what I'm looking at are the estimates for the second and third quarter. And we know that the GDP growth estimates have already been cut, not to recession levels, but to slowdown levels, to like 1% real. And we can see here the green line and the blue line is that the Q2 and Q3 numbers are coming down. Now, they typically come down because that's just how the progression works, but they're coming down, I would say, by a fairly meaningful amount, by about 100 basis points just in the last few weeks. And my sense is that is the market repricing the growth story. Again, we haven't repriced from animal spirits to recession. And if a recession happens, there's going to have to be more haircuts here. But the market is repricing to a slower economy, and then it's a question of will that be all we get, or will there have to be more repricing? So we don't know for now. But just going to slide 15 real quick, you can see that the dollar estimate for 2025, the purple line, it's come down by $10. Again, normally it comes down anyway, but I would say that it's probably coming down a little bit faster than it otherwise would, and that's the market's repricing the earnings story.
Okay. Oh, Fantastic to get that in as we're in the midst of it. Jurrien Timmer, we wish you good travels for Easter, and we'll catch up with you next week. Thank you very much for joining us.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.